Glad to see you all here again. Still getting a pretty decent turnout. Love to see that. We're going to go over some of the stuff that we talked about last time again. You know, we went through a whole big recap, and I just want to reinforce some of those things one more time because I know it's a ton of information. I just want to get the key points across so that you can keep those fresh in your mind. So last time we talked about objectives and risk tolerance a bunch. So here's just a quick recap of all the objectives that you could utilize. So you've got current income, pretty much just trying to generate as much income as possible. Think dividend producing securities, interest bearing securities. You've got balanced, which for me is kind of like that right in the middle, maybe going a little bit more towards the conservative side, but that's kind of, you know, where most people end up is in that balanced area, because most people want some growth and some income, some stability. That just seems to be a very comfortable place to sit for a lot of people. So if you're not really sure, you still want to participate, but you don't want to be all in on equities, great place to be. Growth and income, basically just the more aggressive version of balanced, leaning a little bit more towards those long-term growth prospects. And growth being what it sounds like, trying to grow the pile. And maximum growth obviously being the most aggressive version of all of this, with pretty much no cash reserves, nothing set aside. We're just going all in, and if the market tanks, we'll let it ride. After that, we talked about risk tolerance a bit, all the way from conservative to speculative, which essentially is talking about similar things as objective is, but really just about the level of risk that you're taking with each of those positions. So you can kind of think of it like, if I'm looking at current income, I'll go, all right, I want to pick a really good bond fund. But if I'm speculative and I want speculative income, I might choose something like, I might choose private debt. I might use like senior private loans and stuff like that. Really, still lots of standard deviation on those assets, but you're getting a much higher yield, something like 8 or 9% versus 5% from a government bond fund. So you can kind of use an objective to pick a type of asset and then use a risk tolerance to choose where in that asset class you're going to fall. So you can go all the way from super conservative, like that SGOV fund, all the way to speculative, where you've got derivative income funds, private debt, all sorts of stuff. And then obviously remember the two components of portfolio building, which is our lateral and vertical integration, where we're talking about our time-based allocations in terms of risk level ballooning as we get further out and staying nice and tight as we're closer to when we want to use the assets, managing our systematic risk. Vertical integration, diversifying everything to make sure that we're not too exposed to any one particular risk or company or sector or anything really. So we're not necessarily aiming for those best returns, obviously, like we've talked about over and over again, but for the best likelihood of success given the stated goals of the portfolio. It'd be really nice if we could also get really efficient returns along the way, but if you don't get strong alpha every single year and you're still accomplishing your goals, that's a win. You don't need to worry about outperforming everybody else as long as you still perform well enough to do what it is you set out to do. So also remember that an investment account can be part of the overall portfolio. You can include things like fixed income from a pension or Social Security, as well as real estate assets and all sorts of different things as part of your portfolio. Or you can just evaluate it on its own if that's how you like to do it. If you like to separate all the different accounts and look at them individually, that's totally fine. Whatever makes sense. That's always going to be the number one thing. As long as it makes sense for what you're trying to do and you understand how it's working, that's the most important. If you need to simplify things down to few fund selections, really easy to understand things, just an index fund, just a bond fund, whatever, that's fine, as long as you understand what it is you're doing and why it works. You could even buy an annuity if you really wanted to, if that's the type of product that would make you feel secure. Personally, that's not my favorite type of product because they're high costs. But if that's what's gonna make you feel calm and secure about your situation, and you're gonna be able to move forward with your life and understand that your goals are met, that's a fine product to use as long as you understand what you're paying for. So obviously just rehashing all those diversification concepts and lateral integration, the visual representation of all of that. Talking about how we actually diversify, so using those total market or low-cost index funds to really just get most of the diversification out of the way, and then start getting our more specific and more interesting allocations as we move up with smaller positions. We gave a little bit of a basic allocation guideline that you can use if you just have nowhere to start, and then you can adjust from here based on your risk levels. And then we talked about a bunch of metrics that we can use to evaluate individual securities or portfolios as a whole. So we've got beta, which, as you remember, is a measure of relative volatility compared to the market usually. Although sometimes if you look at a Morningstar report on an individual security, they'll change the index that they're comparing to. So kind of keep that in mind, where if you're looking at, say, like a growth fund, and it's comparing it to a certain growth index, that might be just a little bit different than the S&P. So you aren't always going to be seeing just complete comparisons to the S&P. Or if you're looking at a bond fund and you see it has a beta of 0.8, that doesn't really make any sense. It's treasury bonds. Then you see the index that it's comparing to is an index of treasury bonds. So just sort of a thing you want to keep in mind when you're seeing these relative metrics, always understand what it's being compared to. And then alpha, just looking at those excess returns above what you expect to earn on the security based on the beta. And R squared telling you pretty much how much of the price movements can be explained by movements in a benchmark index that we're comparing to. And remember that the higher the R squared is for the asset and what you're comparing it to, the more useful beta will be because it will be more representative of the relative risk. Because if your asset moves more similarly to the index, then the relative risk compared to the index will be a more useful valuation. And then we've got our non-relative or just sort of isolated metrics. So your mean return, which is it's just kind of an expected return. You're not really, honestly, you're not really expecting to see that on any individual year, but maybe over a long period of time, each of those years might equate to that. Standard deviation, which is really just our basic measurement of volatility. And Sharpe ratio, which is looking at the excess return that we're generating outside of those standard deviation sort of channels and how much more we're getting based on the risk that we took. And then we've got our bond-related stuff. So average effective maturity. Obviously, it's just weighted average of all the maturities of the bonds or other fixed income instruments with all of the puts and calls and all that sort of stuff baked in. And then you've got your average effective duration, which takes that average effective maturity and also includes the coupon rate or the interest rate that's being paid on those securities and uses that to sort of, like I like to say, calculate a payback period. So how long does it take until you've gotten the value of having held all of those bonds for that period of time, in which case you could pull out and the discount from the sale price plus the interest would basically match what you paid in. Yes?
So average effective maturity, is that like the value? When you say weighted average of the maturity, is it a dollar amount or is it?
So it's a time horizon. So so if you think each bond will have a maturity date, how far out it is until then. So you might have some 30-year bonds, 10-year bonds, 5-year bonds, 2-year bonds, and then you average those all together. Also taking into account that some of them may be callable bonds, so they could get called early. So it's like taking all those different factors of how soon are these bonds going to mature or get called away and averaging that all together. And we talked a little bit about credit rating. We didn't dive too much into it, but just know that everything BBB and above is investment grade, and everything under that is considered junk bonds, or more kindly, high yield. So today we're going to just get started on the phase 3 of everything. So we're going to get to, oh yeah, you got a question back there?
Just back up just.
Yep.
So you guys, I learned how to read the expense ratio.
Okay. Yeah.
So you got one that's 0.4%.
0.4
per year.
That's going to be an annual number. Yeah.
Oh, I'm sorry, 0.0.
Okay. All right. I was about to have a problem here. You haven't been listening to me.
Well, the history of the old days, when Vanguard's coming out with index funds at low cost, then the regular retail funds. Their cost is 0.40, not 0.0. And they greedily, if that's a word, they greed along here. They keep people in these index funds that have massive expenses for absolutely.
So 0.4 means for $10,000 it'd be $40 a year. 0.04.
Yeah, something. Yeah, it would be something like that.
Well, 10,000, 1%. right, would be 1,000, so 40%, 1%.
Of 10,000, 1% would not be 1,000. On 10,000, it'd be $100. Yeah, baby. Yeah. So yeah, you're about right.
About 40 bucks.
Yeah.
And then, is that a high number for, I mean, I don't know what the value, is that value high?
So depends on if we're talking about index fund, because that's obviously the easiest thing. Index fund, anything to me over 0.1 is expensive. For an index fund, anything over 0.1, I would consider expensive. Anything under 0.1 or 10 basis points, so 10% of a percent, that would be reasonably priced. Because if it's an index fund, all they're doing is buying the rights to an index and then allocating it and listening to them. That's all that they're doing. Other than providing liquidity and all those other fun things that every fund company is supposed to do, there's nothing really happening. So for an index fund, I want super, super cheap. Like Vanguard's got S&P fund for 3 basis points, I think, so 0.03. FSKAX, which is Fidelity's total market index fund, is 0.015, so 1.5 basis points, which is pretty much nothing in the grand scheme of things. So yeah, that's kind of where I want to see it. Really, like 5 and under is preferable. Like 0.05 and under is where we want to be for a straight index fund, like an equity index fund. Unless we're talking about like a value index or a growth index, I would let that go to 10 or 15. That's just kind of where I'm at.
Use Fidelity brokerage.
Yes. Yeah, there's a couple no cost funds.
But that's their loss.
Sure. Okay, so phase 3 of our whole process, now we're kind of finally getting out of the investment piece and we're talking about looking backwards. It's really where we start obviously monitoring our portfolio. So once we create it, that's one thing, but we still have to keep up on it and maintain it over time. Estate planning maintenance, which usually if your estate is pretty simple, that's not going to come down to a lot. That's just going to be remembering, okay, who did I have? Is this beneficiary in that? Do I still like them? Do I still want them to get my money? All that sort of stuff. Simple things like, are the documents going in the right way? Or if some law changes, knowing how that's going to affect you. Most of us are not going to be using like loopholes that are getting closed anytime soon, or at least I'd hope not. But there are some laws that can change. For example, it's really likely that it's going to get extended, but we're going to come to the point where the estate exemption sunsets, where it's at like 13 million right now, and it's going to come right back down to about 6. For most people, that's not a huge concern, because I imagine not a lot of people are leaving more than $6 million in assets. But if you are, that can introduce some tax complications for estate taxes in the future. I find it pretty unlikely that they're just going to let that happen and not extend it or at least index it for inflation, all those sort of fun things. But we'll see when we get there. Is that 2026?
2025, that it is index for inflation would be 5, but it's like 6 or 7.
Okay.
And that's per person.
Yeah. And then we got our tax efficiency management, which just, when you're taking income, when you're taking assets out of your different accounts, this would be the time to really think about tax efficiency. It's not that you're going to do a whole lot to avoid taxes. If you've got capital gains, you're going to have to eat the capital gains. If you're taking ordinary income, that's going to happen. But if you've got maybe extra assets out of an account that's going to require minimum distributions, it would be a time to think about charitable giving if that's something you want to do, or just all of these different things to make sure that when you're pulling your dollars back out of everything that you've grown, you're doing it in an efficient way where you're not just throwing money at the government for free. Yes. Oh, yep.
About Medicare and like Part B and D and your income 2 years before you start.
Yes.
Is that something you address in tax efficiency or estate planning or?
Yeah, that would definitely be something to think about in terms of, I guess you could call it tax efficiency, but that's like, it's kind of a complicated one. But yeah, essentially you're just trying to make sure that you don't show that now you suddenly have this high income for a certain period of time. And then when they look back on that, they recalculate all of your insurance rates and start charging you an arm and a leg. So that is definitely something that you want to keep in mind.
Talk to your accountant. If you're going to sell something, let's say a property, sell it all at once. If that income resource. And when in 2008, Hartford stock price dropped 90%. So he got out of an annuity, bought some high rate municipal bond, and then all of a sudden, surprise, the client's all mad. Why? well, my Medicare went up, what did you do? So you've got to be careful that whatever you do, see your accountant first on that. Question for you is, if you have shares of an exchange traded fund, I don't know if this works for mutual funds or stocks. Has it helped that much if I say I want some money out of this whole mutual fund that I can't just sell because I've had it for 20 years and it's up a lot? That first in, first out, is that significant or is there not enough there?
I can't say it's significant without a particular situation. So what he's talking about is there's different ways that you can sell the shares that you have in your account. So there's a couple things called first in, first out, last in, first out. And for some, depending on the firm, I know that we can choose it. You can just choose to sell the highest cost shares first. So essentially what that's referring to is if, like say, for example, we're just looking at a stock that just goes up in value, just linear forever. And we bought some at $5, we bought some at $10, we bought some at $15. Now it sits at 20 and we want to sell. If I need just a little bit of money, I would much rather sell my shares that I bought at 15 because I'm only going to pay $5 of capital gains versus if I sell the 5, I pay $15 of capital gains. So you can actually choose which shares you want to buy and sell. I believe you can do that with mutual funds. I don't know how easy they make it for a retail investor, but usually institutional and financial advisors will have more control over those accounts, like their trading staff will be able to do that. I know that we have a lot of that power to do so.
In a non-retirement plan, unqualified, you tend to use ETFs because they're more tax efficient, right? They're internal trading to change cost basis and reduce future taxes when they turn money around.
Yes, but they'll only reduce taxes for distributions because they won't make any.
Right.
They won't ever reduce your tax liability because you're always going to pay the capital gain.
So you don't get that surprise mutual fund. Remember the frustration. I just bought this mutual fund in late summer. And then all of a sudden, at the end of the month, they did a capital gains distribution and I got to pay tax on it. What? That's not fair. Now it increases my cost basis. So when I sell out, I don't pay taxes twice. But the ETF, that doesn't happen. They trade stocks. They cause the share price to go up and you sell and you pay the tax. If they sell something that's up a lot, they trade it for something else. You don't get those unforeseen, unknown tax hits. In April, you didn't know that they were buying and selling in the portfolio, and they were giving you a distribution, reinvesting it. You didn't see the money, but all of a sudden you got to pay the tax. So bottom line is ETFs are more tax efficient, right?
Depending on the circumstance. If we're talking about just holding it for growth, absolutely. But some people will think that it's actually a benefit to get capital gains distributions because that adds to your cost basis. Because when you get that distribution, you pay your taxes on it now. Now you're establishing some extra cost basis for that growth later. And the reason why you don't get those distributions out of an ETF, I think we've talked, I don't remember if we've talked about it this time already, but we'll do it again. The reason that you're not going to pay taxes on an ETF is because, for distributions, because they're not going to make a distribution for one simple reason. A mutual fund buys and sells securities internally. An ETF doesn't usually do that. What they do instead is they have partner firms, authorized participants. Those are the people that buy and sell the stocks. If I'm the ETF company, say I'm a tech fund, I've got my Microsoft and my Apple, and I go, I want to ditch Microsoft and I want Google now. Instead of going into the market and selling all my Google shares, paying all the capital gains taxes and passing that through to my investors, what I'm going to do instead is call up my authorized participant and say, hey, you think you could find me some Google shares? They will go out into the market, do their best efforts to buy shares at the lowest possible price, and then they'll come back over to me and say, I would love to give you some Google shares. How about you exchange with me the Microsoft that you hold? I will give them the Microsoft. They will give me the Google. It's an in-kind transaction, basically. There's no sale. There's no change in anything. They're giving me shares. I'm giving them shares. No sale has happened. So there's no capital gains to be distributed out to my investors. So that's basically how they avoid any sorts of distributions.
Similar to a 1030.
Yes.
I'm a little confused because I've been buying Costco stock at different times.
Mhm.
But when I get the report, it's all lumped into one stock.
Correct.
But you're right, I don't want to sell the Costco stock that I bought low, but then I don't know how that, if I were to sell.
Right. So when you go to place an order in your brokerage account, usually it kind of depends on the platform, how advanced they give you controls to. I know I have, if you use something like Thinkorswim with TD Ameritrade or Schwab now, they give you this control. I think most places should allow you to do this. If not, you can always like call up a broker or something and they should be able to help you. But what you want to do is you want to sell on a last in, first out basis. Because last in, first out is basically what I was talking about. When you have that stock that just kind of goes up over time, those shares that you bought at the highest price, those were the last in. Those were the last ones you bought and put in your account. So those are the first ones you want to take out because they'll have the lowest tax liability. So when you go to place an order in your brokerage account, you should likely have, because you'll be able to choose market or limit order, and then you'll also be able to choose like how, I forget what it's called, but you'll see first in, first out, last in, first out, and last in, first out is usually the default.
Checkbox?
Yeah, it's usually like a little drop down that you get to choose from. Yeah.
You do that if you want to gift shares to a charity or somebody else with a low tax rate, and you say.
That is also exactly what you would want to do. You would want to gift the most appreciated shares first in, first out.
You want to keep the stock, if you want to get rid of the ones that have gained, but your kids need help buying the house, you can give the shares to them, they sell them, they're in lower tax bracket, and then you get the low cost basis shares out of your account.
Yep, exactly.
Wait a minute, say it again. I can give my shares to my kids.
Yeah, if that's non-retirement, right?
Yeah.
Yeah,
You can, that post-tax money versus, IRA, pre-tax.
right, yeah, post-tax money, you have a Charles Schwab account, whatever, you have a bunch of shares. We have clients who do this, if they have Tesla or something, they feel kind of guilty that they spend money, and it's a low cost for those, they can check the box, first in, low cost, give it to the kids are in a low tax bracket, they can sell it.
See any capital gains.
No, because you gifted the shares, they're out of it.
Yeah. So what you'll want to pay attention to is how much you're gifting, because you can gift right now up to $18,000 per person every single year indefinitely, but once a year, and you can give to as many people as you want. And if you go over that amount, which is called the annual exemption, you will start eating away at your estate exemption. So that big $13 million number, every time you gift over $18,000 to a single beneficiary in a year, you're eating away at that total exemption. But you can use that if you're not expecting to have all those assets. So yes. You pay gift taxes.
But you don't pay gift tax until you see.
You can choose to pay gift taxes.
You can choose.
So you basically, like once it goes over that amount, all that happens is you're filing a gift tax return, and then it's just kind of taking away out of that estate tax exemption. That's the only thing that's happening. Nobody's paying any extra taxes on that unless you choose to pay gift taxes instead, in which case you'll pay the taxes on that. And I believe it adds a little bit to their cost basis as well. So if you do choose to pay the gift taxes, some portion of that adds to their cost basis. So it increases it by a little bit because you paid to transfer those shares, and then they'll be able to.
Planning, for example, the 13 million Nash talked about, that if you won the lottery, you had over that, give away the first 13 million, that have the state tax on it, 40%. But next year we dropped it to around 6 or 7%. And if you're a state of private citizen, maybe it's going to go over that in the future, then maybe you want to give these low cost share, and maybe at an asset, you might want to pay the gift tax, because when you give the whole estate away, you don't want them to have to pay on it. And all you have to do is record it, because if your estate grows too big, then what you gave away more than 18,000 per person per spouse, then they're going to come back wanting to take away some of the future. But if you have a partner, then the whole partners can give away that much to each other partner, so it would be 4 times that.
Is there a minimum age for the recipient?
No, but if you're under 18, then you'll probably have to be in the trust.
Or an UTMA or an UGMA. Yeah.
Give them.
So there's two accounts for minors that are not like a trust or anything. There's uniform transfer to minors account, and there's uniform gift to minors account. I don't remember which one does which. One of them like just I forget. One of them like transfers once they turn age of majority, and I don't remember which one that is or what the other one does. But those are two types of minor accounts that people use. Generally, we just use a trust though.
You say on this, I have to set it up.
But you could set up another brokerage account in that title. You
Yeah.
can trustee. Therefore, gifts to minor or. They bring to the door. Is it like a little brokerage account transfer there? And if they're not sold, there's no tax. And someday when I sell them, then. You put something about trust. If you give away 5 million, it's just that if you have more than that, someday when you die, then it's gonna get. That's what you do. Yeah, you can't go on that, and theoretically, you can tell about it, and the break. How you. But, you know, we know there's a lot of funds that are focused on it.
And then is there a trick to give the 401 money?
Qualified account. You can give directly to a charity, but you can give a lump sum, right, maximum 100,000 a year.
Right, but I think we're talking about gifting to a beneficiary, right?
Okay.
Yeah, yeah, so,
Under your fund.
Yeah, you gotta pull out that.
And
yeah.
Then
Yeah, there's no like tax benefits really that you can do, but if you wanted to do something like control, like if you wanted to give that asset, but like you have more control over it, you could make the trust the beneficiary of a 401k or IRA, or just distribute it into that account. But then you're going to have a lot of trust taxes. It just gets messy. It's a lot.
Pull it out every year. Or do something else.
Yeah. Nope, none of that at all. Qualified and IRAs and all that kind of stuff, you're just going to pay the full bill. Roth, you got nothing. Yes. Yeah, so every time, like, you'll get a 1099 statement from your brokerage account. That's going to have all that information. So if you make a sale, they're going to calculate that based on their information. You will want to pay attention, though, if you've moved brokerages a few times, you'll want to look and ask, because you may need to go back and back up that you bought it at a certain price or whatever your cost base. Because I mean, we have accounts where we've transferred in and they just didn't give us the cost basis information at all. So it just says 0 and it's like 3,000% gain or something ridiculous because there's no cost basis information. Yeah. Yeah.
Yeah, but Michael has some costs.
Yeah.
The Roth, when money comes out, it's tax free, right? Yes. Right, off, loss. According to an article I read, if you put a bunch of money in a Roth and you actually go pull it out of a big loss, you can file a loss against the contribution. Back then, I don't know what.
If I give my Roth to my kids, yeah. Is that still a Roth, or is it now converted to a regular?
Still a Roth, right?
Right. Well, so you don't just like gift them your Roth account. That's not quite how that works. If you set up a Roth for them, that's something else.
Don't make money from my Roth.
I don't know about that.
I don't think you can just transfer to a beneficiary. Like, you can make contributions on their behalf, but I don't think you can just roll another account in there.
You could do with this. Yeah. Dot.
Yeah. Yeah.
Then they.
I don't know that.
But they inherit the Roth, and then how long do they have?
10 years,
right,
yeah.
To pull the money out all at once or
Yeah.
time, but it's tax free.
Now, what you could do if you wanted to give them more than like a contribution or something like that, you can withdraw all of your contributions. So all of your basis that you've put in can come out at any time tax-free, and you can always withdraw that. Or if you have met all the qualifications, you can just withdraw that tax-free and then set up some sort of account for them.
And pay each year because they can't. afford the contribution they have to afford. And they-
Yeah.
If they have another plan, they may have to.
Yeah.
Can't do money.
Yeah. Well, if they have another plan, that's not really a concern with a Roth because it's post-tax money.
Um,
If we're talking about a regular IRA,
If you make too much money, you have
if you make way too much, yeah. But usually are.
to put that.
All right, so let's get into portfolio monitoring. And this is going to really just be kind of simple. We're just going to look at what happens when stuff changes. So really, we're just looking at our portfolios and we're asking the same questions as before. Does this meet our goals and objectives? Does this fulfill our cash needs? And is this within my risk tolerance? Does everything make sense? Because all of these things can change all the time. If you have been risk on your whole life and you're doing great, but then you stop working, even if you know numerically you've got all this money and you're going to be fine, you may be a little bit upset by large market fluctuations. And that's just a thing you want to pay attention to because your emotions will play a large part. There's actually a podcast that I just started following. And once we get to where we talk about some podcasts to listen to, I'll give you all the ones I'm listening to right now. But there's one, I think it's like Finance Decoded or something like that. It's by Charles Schwab. And they talk about some different biases and heuristics that people have that affect how they invest and affect how they feel about their investments. But we'll talk about that a little bit more later. So our primary focus always is on our overall portfolio allocations, the types of assets and what they're accomplishing. So what are we trying to do in here? So for example, we got a large account that we want to make sure that we're not having a whole bunch of tax liability on. We make sure that all of our large gain assets are allocated around, and we've got plenty of maybe municipal bonds or treasury bonds, depending on your tax sensitivity. Or if we're looking for growth assets, make sure we're in growth assets and we're not holding a bunch of long-term government bonds and value funds if that's not what we're trying to do. So for example, let's say we've got an investor that's invested exclusively in growth stocks, all growth stocks up until this point, and has seen massive returns year over year. We're talking like 25, 35, 45, 50 good years every year. It's just been a bull market forever. And they've got no bonds, bond funds, doesn't really earn any yield. We're talking like 0.5%, maybe 1% that you see on like an S&P fund. And we're going to assume that distributions are going to fund retirement and that the present value of the account, so how much we've got in there right now, is sufficient. And we're just kind of assuming that they're just going to draw it down to zero. We're not worried about anything else. We're just going to pay out all of this money to fund retirement. So the question is, as they near retirement, as they're coming up on this age where they're going to start taking distributions, what are the challenges they're going to face if their allocation doesn't change at all right now, 100% growth stocks? If nothing changes until we start distributing, what might be a problem or challenge that we're going to run into? Taxes, income, anything else? Longevity. So my main concern is risk. Taxes, we can't really say whether we know what type of account it is, but we're just going to assume it's like a retirement account. But all distributions would require a sale of assets. Now, in a broad sense, that's not necessarily bad, but remember what kind of assets are in here. They're all growth stocks. They're all high risk, high volatility investments. So if every distribution that we make requires a sale of those assets, it requires a sale of a high risk asset, which means that every single day, every quarter, every month, every year that we pass through is a big risk that we could see that volatility kick in a negative way and reduce the assets that we have to distribute from. So there's substantial risk that the portfolio could see a large decline in value right before distributions. Like you could be all the way in Tesla stock and it's been the best for you ever, and then he just makes the worst tweet at the worst possible time and it drops by 30%, and now you have less money. And now your chance of success is just much lower. You might still make it. You might still have a 50 or 60% chance of success, but I much prefer the 95 plus. That just makes me feel much safer. So how would these concerns change the investor's goals and objectives? How would this idea of all this risk, what are we going to start doing? What might we want to change about the types of assets? And what might we want to change about the risk tolerance? Go more towards a balanced allocation. That seemed pretty appropriate. Yeah, so this investor would likely shift their goals to preserving capital because we know that we have enough assets to pay for the distributions. We assumed there was enough money, and generating income because we don't want to just hold it all in cash and distribute that every year. That would be a waste of time. We want to make sure that we're generating income and yield with very low risk so that we're still pulling some extra capital on there, and that yield is increasing our chance of success by the end. So this investor would likely be advised to adjust their allocations over time to suit the new goals and objectives. So if you've got maybe 10 years until that distribution starts, you might want to sell a little bit of equities now, buy some bonds, but give another year for some of it to move. And then the next year, do the same thing. The next year, do the same thing. Slowly transition down to a lower risk profile to something that matches what we're looking for. So the next question that I'll pose is, what types of securities might this investor consider for their new allocations? Putting all the stuff you've learned to work. What kind of stuff do we want to put in this portfolio now? Remember, it's all growth stocks, all just S&P, NASDAQ, whatever, Russell 2000. What kind of stuff do we want to put in there now that we're changing allocations? Some bonds? Anything else? So we're going to use dividend-paying securities or value equities, government debt like treasury bills, notes, or bonds, investment-grade corporate debt, or cash and cash equivalents. All of these things to where we still have some growth potential with our dividend-paying stocks or value stocks, but we're at a lower volatility rate and higher yield, which is kicking off some yield for us to reinvest. We have government debt, so things like treasury bills, like our super short-term treasuries that spit off a nice, decent yield right now. Investment-grade corporate debt. Remember, we don't want to take on too much risk, too much volatility, but we might use an instrument like this to increase yield. But right now, that doesn't really help us because yields are still pretty low in the corporate sector. So high yield is really where you're only getting any benefit. But for this investor, I wouldn't consider that appropriate.
Would you still have that opinion as interest rates for all of those pension funds start popping?
Yeah, so that's a great question. And that also kind of depends on what we're looking at in terms of the investor. Because this investor, we assume, has enough capital to fund distributions, I would still hold that this is a solid investment plan. Because we're still at decently low volatility, and even if it's just a little bit, we're still getting some of that yield to help our account. But if we're somebody that probably is going to need a little bit stronger yield to fund those distributions, I might be looking at just on the tail end of the portfolio, cranking that risk up a little bit of high yield, maybe some like option income, derivative income funds, something that can kick off a little bit more yield for us to utilize while still having the vast majority in stable yield-bearing assets like treasury bonds and stuff like that.
Those assets will go up and down.
Yeah. Yeah, and also bond funds and everything like that will also increase in value.
Well, treasury bills, though, they're stuck for the duration of that.
And if you lock one in 4.5 and the new one's come out at 3.5, yours is going to be worth it.
Yeah, because the value will increase so that proportionally somebody buys that existing bond, it's now matching the open rate, the coupons that are being offered currently.
But it doesn't go the other way. Let's say the interest rate starts going up, and we're still stuck at 3%.
Yes, and that's why we don't like to go long-term bond. So if new rates go up, it's stuck for 30 years, your bond, like Nash talked about, the duration and all that stuff's gonna hurt. But right now, you can buy dividend-paying stocks, preferred stocks, and bonds at whatever maturity, and rates fall, they'll all rise to that. Or like a milk producing cow might be worth more if the price of cattle went down. The slaughter cow price dropped, but the one producing.
So the next question I'm going to pose is, knowing all of this, understanding everything that we just talked about, the different types of assets, the way that things are changing for this investor, how everything is coming together, what are we expecting to be the investor's new risk tolerance? Because that's going to change. So we've got all of our different risk tolerances that we have here, all the way from conservative up to speculative. Now there's a couple right answers. There could be a few right answers. So give me what you think would be your best guess. Where would you put this person if you were in charge of their investments? Here, a bunch of moderately aggressive. I would put them in the lower three here. Because we know that assets are sufficient, because we know that we're going to go for lots of income and yield, these risk tolerances make the most sense. Because we want to make sure that this person is comfortable. We want to make sure that their assets are not going to drop dramatically in value when we go to make a distribution. But we understand that they may have enough assets to where we can take a little bit of risk to combat inflation. So that's kind of what we're looking at. Even if I'm looking at an income portfolio, I'm still looking at a small little slice of that to go into equities, whether it's growth or value, to kind of hedge against that inflation risk. Because if we're still seeing, 3% or 4%, or it gets ridiculous and goes really high, I still want some equity growth to combat that. So even if we're not completely taking care of that risk and we're not addressing all of the purchasing power risk, we're reducing the pain of that just a little bit by having some growth as well as all the yield that's being shot off for us to enjoy for income. So you should do more. Basic allocations are not always going to protect us when markets turn sour. So the hands-on investor should, on a daily basis, just be aware of what's going on outside. Just have your ear out to what's happening to current events and how they're going to affect the economy and your investments. Don't try to be a speculator or an economist who makes 300 guesses and one of them is correct and then they get praised for it on TV. Don't try and predict what's going to happen, but understand that if things are shifting, if things are happening, if interest rates are going to change, whether that's positive or negative, understand how that's going to affect the volatility of your investments. One thing that we talked about, I believe it was last time, is we talked about the election and how that might introduce things to your portfolio. I can't tell you if one candidate winning is going to pump or dump the stock market. What I can tell you, though, is that leading up to it and in the time closely afterwards, it's very likely that the standard deviation is going to widen a lot. There's going to be a lot of short-term volatility that may not throw you off your path long-term, but may be a little concerning when you're watching the stock market fly up and down for a while. So just pay attention to what's happening. And if you feel that you need to have very stable assets at this current point in your plan, back out of some growth equities, back out of tech funds, back out of things that may be affected by some things in the election. Understand that policy changes will not happen as soon as somebody gets elected. You've got plenty of time, but just be kind of aware of what's coming and be able to position yourself in a way that you're not just exposing yourself to extra volatility for no reason. So also pay attention to changes in the tax code or other laws and how the implications could affect your strategies. There's plenty of things like mega backdoor Roths or something I haven't really learned much about, but we don't really dive too much into because it's one of those things that kind of feels like a loophole that could be closed at any given time. And when the IRS closes loopholes, they don't say, oh, you just can't do it anymore. They turn around and they look at everything that you've done in the past and go, we would like those tax dollars, please. Thank you very much. And then they charge you back taxes for a lot of that. I don't know how far they always look back, but they will happily go back on all your transactions and go, you were doing this whole time, and we didn't think that was okay. We didn't say anything, but that doesn't matter. Thank you very much for the revenue. So just pay attention to how much finagling you're doing with your tax strategies, because the IRS, if they close down a loophole, they will look back on your history and try and charge you for it. Yes.
Recommendations for tracking current events, like sources. Yeah, the news is so polarizing.
Yeah, that's why I just like I like news that is suited for this industry specifically, because they're very nonpartisan, they're non-biased, they don't take sides, which is really nice. So we'll talk about a couple news sources that I use later, but Bloomberg is great. I like a lot of the stuff that they do. There's sure plenty of opinion articles, but they just don't seem so they don't seem to join my side about this sort of thing. It's just kind of, here's what's happening and here's what we think may occur in the markets. Big broker dealers will all often have research teams. So Charles Schwab, Morgan Stanley, a lot of those big names will have research departments that they'll put out their research for their investors for education, because the SEC makes them, and they just provide a lot of information for that. And their analyst teams will post a lot of things. So you can look at that.
It's a good daily recap.
Yeah.
Talk would be good, and then this app that I have on the iPhone, does everybody just get this app? Or
What, the stocks app?
Yeah.
Yeah, that
Everybody has it, and then
yeah.
it has news on it.
I don't really look at that too much, to be honest with you, because a lot of, like, I noticed that there's a lot of like websites that talk about specific funds and give you data, and they just like the amount of articles that I'll see that are attached to like an S&P index fund but are just completely generic. Like that, it's just noise to me. So I like to kind of
Yahoo Finance.
Yahoo Finance to me is like a good free way to look at an individual security. Other than that, I'm not looking too much at their news or whatnot.
Just a general question, how up to date is Investopedia?
Investopedia is pretty current, very good. Investopedia is what I like to use to understand basic concepts, just kind of get your foundations. So if anything has confused you, Investopedia is where I would go search up whatever term it is, or just Google this term that I'm confused about, Investopedia, and I bet you it will come right up.
Daily?
I'm not sure how often it is. It depends on what they're talking about. But Investopedia and NerdWallet are two pretty solid sources. They got a lot of good information on those.
You have to be a member of Schwab and Stanley to take advantage of the research.
I don't think so. I'm pretty sure most of that's just open to investors.
Have an open free part.
Yeah. Yeah. Bloomberg is one of those ones where they'll charge you a membership fee to read like full articles and stuff like that. But I think there are some basic things you can see. Yes.
Say, I signed up personally and you can sign up and I think weekly or daily articles. So if you sign up for different categories, you can get a lot of free information.
Well, there we go. That might be something that we want to email out. Yeah, thank you. So also just keep an eye on the activities of the Fed too, like interest rates, monetary easing or tightening, spending and all sorts of stuff, like how they're just affecting the markets like that. It's always a good thing. The interest rates are the easiest one to understand. So that's where I put most of your focus, because that's going to directly impact your bond holdings. On a weekly basis, just make sure you monitor news about your funds, updates of if things are changing, or if you're in like a mutual fund, pay attention to their capital gains distributions so you know when they're coming, you know how much. Even if you can't really do anything to prevent yourself from getting them, just pay a little bit of attention on those distributions if that's a really critical part of your plan. If you're kind of used to just getting the income, I wouldn't worry too much about it, but that is something that could be important. Measure the key portfolio and fund metrics. All the risk stuff that we talked about. I wouldn't be making changes to your portfolio weekly. I don't want to see 52 trades a year, but it's good to just keep watch. Just kind of maybe on like a Friday, like once the market closes, pull up your stuff, or even on the weekend, like get a nice cup of coffee, sit out on the porch and pull up your portfolio and go, how is everything looking risk-wise? How are the portfolios looking? What sectors have done really well, really poorly? Is there anything that's coming up that I need to be aware of? So you can just kind of tactically look and go, okay, where am I exposed to risk the most? And maybe address a situation if it's needed. So using software like Morningstar can really simplify that process. I love Morningstar. Morningstar Investor is a great software, and you can get a lot of information about the funds and portfolios that way. But there's a lot of other free tools that you can use as well. And actually, one that I've been using kind of recently to look at all the holdings of a mutual fund or an ETF is stockanalysis.com. I recently found that that was helpful because Morningstar, I could only see the top 10 or 20 holdings or whatever it was. But if I go to stockanalysis.com, pull up the ETF and click on holdings, I can see everything that's in there. So I've been using that to research a couple new ETFs that I've been hearing about, like a recent crypto ETF that I found very fascinating.
Are you listening to ETF Prime?
Yes.
So that's a good one.
Yeah, we'll get to that in just a second. So note the runners and detractors of your portfolio. Like I was saying, just kind of pay attention to those sector performances, or if you've got like particular funds, those smaller allocations that we talked about moving up the pyramid, you can pay attention to those and be aware of the circumstances that may be contributing to their performance. So if you see that utilities has just been on an absolute tear recently and then it dumped by 2% today, it'd be interesting to figure out why that happened. I don't know why, but it would be interesting to see. So just kind of being aware of like what is happening around the holdings of your portfolio. If you like to keep it generic and simple with index funds and short-term bonds, you're not going to be doing a lot of a lot of adjustments for the economic news and stuff like that, but you may adjust your risk exposure up and down. But if you like to have a little bit more fun with particular holdings, super concentrated sectors, this would be something I would highly recommend you do frequently. So continue your education. Like, we're giving you a lot of good information here that you can utilize, but keep listening, keep your ears open to what's out there with podcasts, articles, and more from reputable sources. Just a random guy on YouTube is not who I'd be listening to for your best information advice. Make sure it's coming from reputable firms or just people who are using just common sense investment advice. A lot of the stuff that you'll see here, you can, if you go and listen to some people out there on the internet, you'll hear where it clashes. And if you're hearing like, if it feels like a red flag, just turn around and don't listen anymore. But if you want to have some good podcasts to listen to, here's a few that I have been listening to. Let me pull them up right here. So I've got Bloomberg Business Week. That's one that I listen to. I'm going to start listening to Washington Wise by Charles Schwab. That's also something that will be interesting because they talk about how elections and politics and all of that can play into your portfolio and investments. Washington Wise. Wise, yeah. And then ETF Prime is one that I listen to frequently, just listening for new products. And it was interesting. The last one, did you listen to the last one?
No.
So the last one was talking about, you remember leveraged ETFs? So there are these products where essentially what they try to do was give you like 2x or 3x or 5x the return of some index S&P, but over a day's basis. So essentially they would buy swaps or futures or whatever it is to increase the leverage of the portfolio, but for just 1 day's period, and then would reset. And then they would do it for the next day and the next day. And all these contracts they would close them out by the end of the day, and then the next day they would open up new positions. So what that had was this like volatility decay, where if you had a leveraged ETF and you had negative returns, it would compound much faster than just like a buy and hold of a lot of the asset would have. So you'd have really, really poor performance, and they'd have inverse ones as well. And those just have done absolutely horrible. They're basically things that you just want to use on like a short, like a day trade, basically, where if you just know that there's going to be some crazy volatility, you want to make a directional bet, a leveraged ETF might be a good product. But they're not a good buy and hold. They're not useful for our portfolios. But what they were talking about was they're now releasing leveraged ETFs that don't reset every day, but rather every week, every month, and every quarter. So that introduces a new type of investment product where if you want to make a directional bet for a little bit longer period of time, you could have that quarter-long reset period where you can actually feel a proper like 3x or 2x return over that period of time, because that's when the contracts expire. Anyway, that's a little bit more advanced. I would not recommend using these products. They are super volatile, super complex to understand, and if you get on the wrong side of them, they will tear your account to shreds. Yes.
Chart I've ever seen go from one figure down to almost zero over a period.
Yep.
If you know how to use them, maybe you want to handle, you could write out 3,000 a year, right?
Yeah, exactly. And if you got some play money, why not?
So the software like Morningstar, is that the same thing that you're giving us access to through that Fairfax County Library? Is that
Yes,
a
yeah.
database, or is that a software, or both?
So it's basically like,
Track?
yeah, that Morningstar Investor is what I would use to like look at those different figures based on your portfolio, stuff like that. And if you want a more advanced like Morningstar look, so there's two different versions of Morningstar. There's Morningstar Investor, which is for all of you, and then there's Advisor Workstation, which is the incredibly expensive version of that we use in our office. So if you want to see a little bit more in-depth breakdown of your portfolio, feel free to bring it in and we'll run it for you, no cost, don't have to become a client, none of that. We'll just run it for you and point out anything that we notice.
I think the institutional version we want like
Yeah. Yeah, Bloomberg actually has some crazy expensive stuff. Bloomberg Terminal, what is that, like 25,000 a year or something like that? Yeah. Oh,
25,000.
something like, I don't know. Yeah.
Or out of our levels.
Yeah.
Yeah, or we're not speculating, creating mutual funds. Yes, mutual funds were exchange traded.
Yeah. So ETF Prime is, oh, yes.
I don't know if I can call him a friend, but I know somebody who, raised some TQQQ high, really high. Like he's kind of, he always makes money. That's a leverage
Okay.
thing. Is that like a gambler saying that he always makes money gambling? Just doesn't say. Actually, if he knows.
I think they're saying that because if somebody knew what they were doing, they could get it every time. If you cheat on poker. That would be like a reverse, a leverage, technology, right? It follows people, index and then leverage it. Or it's like real estate, they borrow a bunch of money, put a little down, and if the market goes up, they sell it, and that's all. And so I would be suspect, if he makes it in the long term by getting him, what he's doing is he's buying more than what is actually going. Right, if you invest 100,000, you find 200,000, they're borrowing the money, and if it goes down, then it can't multiply it long. If it goes down 50%, it's better.
Yeah, because what he's saying is completely contrary to what I think that it's heard, so like.
Yeah, kind of like if you were to buy a condo in Hawaii and put a certain amount, you put down 50 to borrow 50, well, the place drops 50,000, you have to sell it. But that's the problem, you have to sell it, get out. Like it is, then lose your down payment, right? If it's not 50,000. So I would be somewhat suspect of anybody who says that it's consistent, they can shut the market down. I think they can bring the markets out of everybody now if they were that good at that. Now, there's some good, some managers out there that are good at gambling, or making, taking position. Elon Musk takes a position that I'm gonna do rockets, but I watched the videos on the last rocket he did before he had success, and he almost had a heart attack. Because he knew that if that rocket blows up, he's done. And so, that's the one thing we need to watch out for, people that get up there, I'm so smart, I've made all this money. Yeah, they gamble each time and they've been successful for the most part. But I don't have that much, desensitized feeling. Probably more conservative. But if you do want to leverage, like we do, my house had a loan on it, right? I bought it for one low amount, the house is way up at that, if that was a good long term one. But if you short term, I cut off 0 to 50%. That thing, right? So we have these long term. If you do that long term, put down half and double it and pull that position for a year. No doubt, we probably would have done fantastic. Probably position before that. He said, about a $3,000 right off loss instead of taking, but you want to.
Yes, you can kind of see this ETF actually manages that leverage like pretty decently, but you can see that when you have a loss period, look at how aggressive that is. And look at the speed. Like it's not just like, oh yeah, over time we finally like, yeah, we have this nice long gain and then within half a year, all gone. Immediately. Now, if it's just going to grow continuously, bull market, sure, it looks great. Like if we go to max time frame on this, the Nasdaq's done 7,200%, while it's done 16,000. So sure, yeah, if we hold it like this forever and it just continues to be a bull market, it could be good. But just look at how aggressive that decline is. So I would just, sure, you can make more money in a bull market, but just understand how much that widens your volatility. So if you want to take that into account, great. If that works for you, fine. But just be very aware of what that actually looks like on a day-to-day basis. Because you can also see, this is supposed to get 3 times the return. There are some where it doesn't quite. Over 1 month, it's done just about the same, which is not to say that it's a bad product, but it's just saying like, again, you see like some kind of consistency, and then that drop is just immediate and all the way down, drops all the way under the value. So
That's 1 month.
Yeah.
The NASDAQ did 323%.
no, NASDAQ did 1.84. Yeah. And if you see over a 6 month, you get about double, almost a little over double the return. But again, because it resets every day, it's going to be a little off. It's not going to be a perfect 3x every single time for every period. Year to date,
The fund has
kind of similar. It's not necessarily borrowing money. No,
how are they getting 3x?
they would use derivatives.
Over it, but they expire, right?
Yeah, so that's what that daily reset is. So every day they're using a different set of swaps and contracts and all sorts of.
They don't pan out, they evaporate, they fund, right? They're gone.
Yeah, I don't know exactly what instruments they're saying, so I can't say that for sure. But it's not like you pay for the contract and then if it doesn't, because you're just making a leverage bet, not a price bet. So it's just leverage.
So it's like an option, market is like the correction.
But it's not like options though, because an option will expire worthless. This is not that. This is leverage. So it's leverage either way. So that means that we're having 3x up or 3x down. It doesn't mean that once the contract resets that it's worthless and now the entire value of the fund evaporates.
Is that wait longer? Hoping that market will come back.
Kind of, yes. And it's just, again, it's just the NASDAQ, but leveraged up.
Leverage.
Yeah. Okay. So, yeah, that's why we don't recommend that people look at leverage products, because it's just a lot. It's a lot to understand and it's a lot to factor in. And for most investors, they're not suitable. They're just simply not suitable. So just take on the proper risk with diversified index funds and you'll be all right. So anyway, continuing about the podcasts, ETF Prime is a great one for learning about new products. Again, remember that's your smaller allocations. That's maybe the top of the pyramid or the midsection, where we're looking at new products that talk about sectors, maybe actively managed solutions. Maybe there's some fixed income funds that do really well. But ETF Prime is great to just sort of be in the conversation about all the new products that are coming out and things that you might want to be involved in. Oftentimes they'll talk about new products that have like no time behind them. We don't know how they're going to pan out, or it might be an actively managed solution that could or could not do well. So just do your due diligence and really look into what you're doing and make sure you're on board with their strategy if you want to invest in any of these new funds. The next one is Morningstar, the long view. That one's good for some general conversations about retirement and like Medicare and all sorts of different things about just generally retiring and financial planning. So that's a really good one. And then Financial Decoder is the one that I was just talking about earlier, another one from Charles Schwab that essentially just takes down some of these concepts, some biases and different things that can affect you, and will break them down in a simple way for you to understand so you can know what lenses you're looking through when you're looking at your investments. So on a monthly basis, that's when I would go shopping. I would go look at your funds and see what you're comparing to, see if you can maybe drop some cost if you feel like doing that, or if you can get some better risk-adjusted returns over time. Remember, don't just look at one-year periods, because any active growth fund could, in a relatively tame market, if they hit some good stocks, they could have amazing alpha. And then you look over 10 years and they've underperformed every single year for the last decade. So just pay attention to longer term data, pay attention to the strategies, and understand what you're getting into. But you can look for possibly cheaper for similar exposure, or just some kind of different fund that is doing something that you want. Use this as an opportunity to bring the overall portfolio cost down. So if you've got like a 60, 70, 80 basis point portfolio, you definitely want to be shopping for new funds that are cheaper, that give you very similar exposure. That's another reason why I like to use Morningstar, because I can look at a particular fund and I can go, this cost me 80 basis points. It's a large cap growth fund and it gives me 17% standard deviation, and it's done this well over this period of time. And then I'll go into the screener and I'll start looking at all the available ETFs, and I go, okay, out of large cap growth with a standard deviation around this range, who has been performing the best? Sharp ratio is what I usually like to use because it's not a comparative measurement of performance. It's isolated to that fund. But then I'll look and see if there's something that is super similar for maybe 20 or 15 basis points that I can swap for. Assuming that you're not in a taxable account and going to pay a whole bunch of capital gains and all that fun stuff. So loss positions are great candidates for replacement. If you've got a position that's down 25%, celebrate, because now we can reduce the expense ratio and not pay a tax bill for it. So if you have a position that's just doing really poorly, look at this for an opportunity to do what we call a lateral exchange, where you're looking at your one asset that's down by 25% and you go, I could probably get another fund that is cheaper, performs better over the 10 years or 5 years, and I can sell off this loss position and buy this other one, and then I don't have to look at the red number anymore. And now as it goes up in value, it's also cheaper, so you'll get more efficient returns. Maybe it just performs better, period, and you'll get better returns. And now you get to see a nice gain position. And you can use some of those capital losses either to offset other gains or against your ordinary income, up to $3,000 a year. And you can carry that forward. Yeah, kind of. Tax loss harvest, it's kind of the similar concept. Tax loss harvesting is more if you really want to pull losses out of a portfolio, or if you want to counteract other positions, then you're looking to really look for all those losses. Here, I'm just looking for if I can take a loss position and make it a better version of what it already is, then I'll make that trade. But if I can't, if energy is just down still and I'm in a nice cheap energy index fund, there's no reason to swap. You might as well just let it go. You can see if old mutual funds have transitioned into new ETFs and if they're suitable for you. So there are some mutual fund companies that will do programs where they'll swap your mutual fund for a new ETF. So it's possible that might be interesting if you are feeling those capital gains distributions a little bit. On a quarterly basis, we want to dive into the metrics of your portfolio and make changes when needed. So if you really want to be doing some more active trading, quarterly is probably like as frequent as I would want to be, depending on obviously the economic outlook and what we're seeing in the markets. But on a quarterly basis is when, if you have any thoughts about your portfolio, if there's something you want to change, this is probably when I would start doing those, either rebalancing or adjusting your allocations to adjust your risk. So make sure that you're looking at your objectives, risk tolerance, portfolio income, risk-adjusted returns, expense, and get rid of your undesirable funds. Get rid of the things that we just don't want to have in there. Poor performers, super expensive, all that kind of stuff. But really, it's just going back and looking at what we did initially when we built the portfolio and reevaluating it again. Because sometimes we, especially if we're looking at a taxable account, we might only deal with like a quarter of the portfolio at first because we just don't want to handle all these capital gains, all these different sales, and we want to move over time. So quarterly is a really good sort of tempo to move at for rebalancing and stuff like that. Yes?
Is it too simplified? And I haven't used a lot of analysis on Sharpe ratio, but if I looked at all the funds that have similar large cap value and expense ratios are similar, would you be looking for the one that has the highest Sharpe ratio, or is that too much difference in alpha?
So when I look at funds for particular sectors or a particular, like if I go, okay, I've decided I want a US value fund here. The number one metric that I will look at, assuming that everything else is in line, is 10-year Sharpe, the 10-year Sharpe ratio. Because if you can outperform your standard deviation over 10 years, at some decent little level, then I have solid confidence that that's going to continue. If I'm looking at 5 years or 3 years, it could have just been a straight bull market for the last 3 years. Totally possible. Like, I'm sure a NASDAQ fund looks really good over the last year or so, or year to date. Yes?
Does that do the homework for you?
That is what, if I were going to boil it down to one thing, as long as my standard deviation is in line with what I want it to be, as long as the expense is in line with what I want it to be, if I was going to just boil it down to what is going to rank the 10-year Sharpe ratio is what I would use. That's just what that's how I found SGOV, which is now the highest yielding, or I think it was either Sharpe or just sorted by SEC yield, but stuff like that. You just sort it and you will be surprised at how nice the funds are at the top. And spoiler alert, most of them are index funds. almost every time. Almost every time, the ones that perform the best are index or factor funds with just little slight tweaks to how they're choosing securities. So biannually, this would probably be when you do your actual rebalance trades. So if you're staying within a certain allocation, quarterly you can look to improve things, and biannually you probably just do your actual rebalancing if you're going to pull your equities back down to your 55% or whatever it is. But don't get too aggressive with rebalancing. It's okay to let positions ride for a little bit. It's okay if you like staying with a really good percentage and you're tactical about how you're moving around, but just make sure that you're not chopping off good performers right as they start taking off every time. Because if you just keep chopping your stocks off and chopping them off, they're not going to have the chance to run and give you those good returns. Now, that's not to say that we can really predict when they're going to start running, when they're going to stop running, how long they're going to run for, but you just don't want to cut any position too quickly because you want to allow it to take the time to get those average returns over time. On an annual basis, this is when you turn around and you look in the mirror. This is when you start looking at yourself and basically look at your objectives, your risk tolerance, liquidity needs, and just see if anything's changed. Because every year you should just be able to sit down and go, has anything changed since the last time I did this? Am I spending more right now? Is my risk tolerance lower? Have I just gotten a little bit more antsy about the stock market? This would be the time to make that change and tell yourself, okay, I need to change my investment plan because this is causing me undue stress, or I need to hire an advisor because I just can't do this anymore. Really evaluate that on an annual basis and really just review yourself. Review what you want. Review the relationships you have with your professionals. Review everything. Like, just look at how you feel about everything that's happening in your plan and go through the diagnostics again. All the different stuff that we talked about. Do your cash flow again. Look at your insurance coverages. It's not frequent that these things are going to change dramatically, but you always just want to look one more time and go, did I miss anything last year? Did something change this year that I wasn't prepared for? Did I take a huge distribution out of a protected account and now I have these vulnerable assets that a creditor could come after? You want to make sure that you're up to date on all those things. Estate planning, tax planning, just all these different things. Just make sure that every year you're staying in line with the objectives that you want to fulfill. And don't be scared of change, because if something about your portfolio or your needs change, you need to act on it now, today. You need to make sure that you get everything in line with your plan, going in the right direction, because you are your own advisor and fiduciary. No matter how much, like, you can listen to different information, no matter how you can listen to my suggestions, you are responsible for all the investments in your allocations. You're responsible for acting in your own best interest, even when that collides with what you might be feeling emotionally. That's what those biases do for us. The things like recency bias, anchoring bias, a lot of these things that you can also look up on Investopedia if you want to. But if you look up investor biases and stuff like that, you can see a lot of things that in the moment you wouldn't really think are affecting you. But you could look back on an investment decision and go, oh man, I sold out all of my S&P right as the market crashed 20%. And immediately after that, it rallied back up and more. And there's just some things like that where you want to make sure that you have a plan that actually fits you, not just the number you're trying to hit, but fits you personally. So you know you can stick with it long term.
In the book, we copied somebody's, the bullet was providing. That's it. Microsoft somewhere. Or maybe if I do it, it takes off. So in investor behavior chart.
Yeah. So we're going to look at a couple different real world events that shifted our outlook a bit. There's a lot of times in history where the game just straight up changed and we needed to adapt. So let's look at a few. There's the obvious one. 2008, we all remember it. Famously, these big subprime lenders just gave cheap loans to pretty much anybody breathing. It didn't matter whether you had income, had a credit score, or really even a real person. you could get a mortgage. I remember it was the movie The Big Short, which is just one of my favorite movies of all time. I love that movie, star-studded cast, really good at explaining the concepts. But there was a scene where they were asking a tenant about their landlord, like how could they get in contact with their landlord? And they were like saying his name, and they go, "That's my landlord's dog." And that's the person that was on the mortgage. The dog was responsible for the mortgage. And obviously he wasn't paying, because what job is he doing? So after the dot-com bubble, the Fed lowered the federal funds rate all the way down to 1%. So it was previously at 6.5%. This is the rate that banks are lending each other money, and kind of like a base rate that you can think of. Then they're going to add a rate on top of that when they lend it to you. And they dropped that all the way down to 1%. So these low rates sent house prices really high up, because when it's really easy to borrow money, it's really easy to borrow more money and pay more for the value of the home. So Wall Street banks bought and repackaged subprime loans into low risk mortgage-backed securities and collateralized debt obligations. Essentially what this means is, say I'm looking at the front row here, and all of you have subprime mortgages. You're not it's high risk. You guys are probably going to default on your loans, but I'm going to take all of that and package it together. And because I'm putting it together into one security, I'm kind of diversifying the risk, right? And then I'll take my product over to a risk assessor like Moody's or S&P, and they'll rate it higher than the underlyings. So if these are like C's and D's, but maybe they give me a double B rating. Now I can sell that to an investment bank and go, this is investment grade. It's a great bond. Why don't you buy this? Tons of mortgage income that's coming in. And so the rates started to rise on these.
I think we all knew coming down, but they were seduced by the easy, quote unquote, easy money.
Right.
And leaving you with it, leaving us with it.
Yeah, absolutely. So as the rates started to go up, homeownership kind of reached a saturation point. Like pretty much everybody had bought their home, second home, third home they were going to flip. They just like everybody had all these homes, and people were getting these adjustable rate mortgages. And because rates were nice and low, it was super affordable. But then the rates started to climb up, and those adjustable rates, you like have a certain period where you're paying your low rate, and then it adjusts to the market. And so when those mortgages started to adjust up to the market, people realized, oh my God, I can't afford my mortgage anymore. So defaults on these subprime mortgages, remember subprime is being really high risk, people that don't have a high likelihood of paying this loan back, they started to really, really rise. And the borrowers were owing more on the loans than the houses were worth, because the interest rates were rising, the house values were falling, demand was low, so just prices were crumbling, but the loan stayed the same. They don't adjust the loan for how much your house is worth, they adjust it for how much interest you haven't paid yet. And so these big lending giants were on the verge of collapse, because all of these underlying loans that they just handed out to everybody were just defaulting, and everything that they had was just falling apart, essentially. The housing market just completely fell to its knees because nobody could afford to buy anything. All of their money was tied up in these adjustable rate mortgages and just defaulting, and they just had nothing. Yeah.
Well, that single thing for commercial retail bankers they were basically able to combine their do both activities, because apparently there was a wall between them, but they were separate. Now, I hear that is going to, or I read this a while back, the statement back in my mind, where there is room again for more use of the banking industry because of this. What do you really
Any insights?
The biggest problem was the rating cut. The rating cut. You know, playing with banks, consolidate mortgages and sell them on, say, hey, from their play, let's go get the rating company. So that, when the rating company gives you a AAA, when they're actually triple B, and then the market gets wonky, then they drop in value when they get go out of business. But I had to do, and ask your mom about this, we had to do massive block trades for our clients. that once it dawned on me that they're gonna calculate the credit rating bond. Right, if we had investors, triple B, single A, double A, okay, fine, but I know triple B should be dramatically, and they're gonna drop to double B, we're out of there. So we had to go back and do block trades, get our clients out of any investment grade, because triple B is fine today. But back then, if you know that we came through this crisis and these triple Bs are still rated as triple B, and they should be lower, let's get the heck out of it. So we got clients out of it, and then they've recorrected, and the bonds dropped in value. And then we bought back into real triple Bs, not the old triple Bs that dropped to double %. So the rating agencies are the ones that really.
The rating agency was currently regulated by some form of federal government.
Yeah, but they were being paid by the people wanting the bonds regulated. That's where they made the money.
No, it was incredibly corrupt. It was really bad.
Self-regulating yourselves.
Yeah, it's different now. The government is down on, but I don't like the banks and everybody that sold these products, and they can do that for lower credit rating than what the regulators do. But and this is why we don't encourage it if you want to do it. Nothing wrong with the concept of social security. But you're gonna put all your money with one investment company, you might think it's safer than whatever you get. And if they fail, they can't take those because if they investment company inappropriate for that needs. Now, someday there'll be an exchange traded mutual fund that has 100, and you can have your money spread out. But putting all your money with one company, that's pretty crazy. Like buying one bond that had a triple A rating, but you might have it.
When you did all the bond trading,
Yeah.
lost some money.
No, they hadn't dropped yet. They weren't reassessed. Yeah, we knew that sooner or later they're gonna be, the rating companies are gonna get in trouble. They're gonna have,
coming.
they're gonna have to reassess these bonds. And if the bonds drop from triple B to single B, you know the value's gonna drop. That's why we got out. We went to higher rated bonds, waited it out, then we bought back into triple.
I did have somebody who's gonna be declining in the budget.
I wish I was so smart. I went to a conference and I listened to Bill Gross, remember him? The bond king guy. Now they think he's lost it, but he was big time. And I went to a conference in Southern California, fixed income ETF conference, and listened to all these people that are right there in Washington and all that kind of stuff. And I came away saying, we got to do this. So I wish I could say I came up with it, but that's why we go to conferences. Well, it's a tax deductible vacation. That's why I
Exactly.
go. I'm going in 2 weeks to Newport. It's the only trip to vacations I get.
You're changing my image.
No, that's right. Yeah, but we learned, look what we learned. I was able to save our clients a lot of grief by listening to all the top brains. And they controlled all this stuff, and they're saying, yeah, these bonds should be rated triple B or single A. So we just got to move down.
If I could just, can I continue with the
Sure.
train of thought there? Because, Walgreens, name a name. I think they were A or something like that. They tanked quite a bit, and I'm still holding their bond. So, is it worth my while to unload?
If you need a tax loss, you can carry 3,000 a year, right? Or if you think somebody might buy them out, they might get a little better, but I've never seen bonds that dropped a lot because of problems zoom up a lot in value. Stocks might, but I haven't seen bonds, I could be wrong. But if it's not in a retirement plan, you might sell off some and take the loss, or sell off a big piece and you take 3,000 a year, or save that to offset any other gain. Do some loss harvest. Maybe you have some positions that are up a lot. You want to whitewash or offset their gain. You could do that. But the credit rating of those bonds have probably dropped, right?
Yeah.
Okay. So, so if somebody bought them from you, I don't like owning individual bonds. That's why we talk about either have a really good bond manager, and they let us down in 2022. If they have a really good long-term bond, I was waiting for them to start going to short term, and they never did, and they lost a lot of money. So I personally would get out of bonds and get into a fund that is, I feel funds that are good manager a lot of them. But you own one bond from one company.
But most of them, but Walgreens, right, but it's non-qualified.
Yeah,
So
non-qualified.
I don't really get to write out anything.
If it's non-qualified, not a retirement plan, you can sell it if it's a loss, you can buy it on that loss. So it's part of my 401. Okay, so you don't get a loan, but it's less money to pay tax on something. I came up with that sarcastic.
Yeah.
Less money to pay tax on, so in a sense, you have to write it off. So, it's a big risk if you hang on to it, because there'll be bottom fishers that hold like Franklin, Temple, and all these other. They lost a bunch of money, beyond bond, but bad, they owned them, they compensated you. That's the story. But, I probably risk thought, it's worth what it's worth with a low rating today. I'd sell it, buy something else, if I didn't want to do it. I've never seen bonds move all the way back.
Yeah. You know what, like coupon rate you're getting on that bond?
I don't know
What the interest rate?
on it.
Coupon is just the original interest rate, like as it was issued. Like when you bought it, it'll be Walgreens something this percent.
So I attend this class, the more I know the significance of some of the terminology factors. I'm looking at.
Yeah.
So I even know, I'm gonna look and see what.
Okay. Yeah, because that would be something that I'd be curious about, like how much interest are you earning on this? Because if it's a decently high number, maybe hold on to it as knowing that it's a high risk position. But if it's like, if it was a downgraded bond, it probably doesn't have a very high interest rate, which means it's probably worth even less than a low credit rating bond, because it's not even compensating you for that risk. You're getting like triple B rates for like triple C credit rating, which would be horrible, and I would just back out.
Your on the discount, whatever you were getting, say, 4 equates to the B.
Yeah.
Higher you want.
I
Yeah.
need to look at the interest rate and the coupon rate.
Well,
Yeah.
kind of the same, the coupons, back when you guys were kids, your parents had a certificate of a bond, you know, how old were you? Kind of like.
A&W, or S&W.
S&W coupon, yeah, but these have the certificate and all these little coupons, you tear off a little coupon once a year, give it to the bank, and then they'll give you the interest represented on the bond. That's why in the old bond, James Bond movies, you see them breaking into the vault to steal the bond. Well, they had bond certificates, and then if they were coupon bond, the some were a certificate, you wait 10 years to get all the interest and money, or you put coupons and take it to the bank your interest on a yearly or quarterly basis. That's why we call them clipping coupons. They don't exist anymore. That's what they used to do. Now, if bond certificates got stolen, it would be like they could go cash them in.
So just to finish up this little conversation here about the subprime thing, over 25 subprime lenders completely went under, like they imploded. They're gone. They're not in business anymore. And the United States' 2 largest home lenders, Fannie Mae and Freddie Mac, were seized by the government. They had to be taken over by the US government because it was so bad. We saw the largest single bankruptcy in US history, which was Lehman Brothers. And here's a little breakdown of the costs of what happened in 2008. The Bear Stearns bailout was $30 billion. Fannie and Freddie bailout, $187 billion. TARP bank bailout, $440 billion. ARRA tax cuts and spending, $831 billion. So 2008 cost us roughly $1.5 trillion because of what happened with those bonds. And that was because of, like we talked about, those rating agencies giving out ratings for fees because they.
I mean, I'm a big timer.
Yeah. Yeah.
The government claims that everybody paid back everything. That they were given a bailout for a while, that they paid it back. Some of the banks didn't want the money, but they were forced to take it because they want to make sure the others got it. But if your business failed, who's going to bail you out? With a taxpayer getting a short-term loan for about 1 year, so they get it all back. That doesn't make it better or at all. But I did, and it confirmed at the conference that if you have a brokerage account, you have all these little exchange traded mutual funds that we call them. The actual mutual fund company holds the certificate and the security, they just report to your brokerage account. But that's important because one of our big selling points on our portfolio is we want you to see Vanguard in there, we want you to see Fidelity, Schwab, Pioneer, company, because if one of them got hacked, that Vanguard would say, you've got other funds in the portfolio that you can sell. Now, if they went after your Fidelity or Schwab account, they have like $1 billion of each portfolio that extra coverage.
No, even though that was a horrible time, it's a lot of opportunities,
Absolutely.
especially with banks, you could buy a preferred bank stock.
Oh, yeah.
Oh, yeah.
For half par value, by $25 par, by 15, and you get 7% interest.
Yeah. And this is what,
$25.
yeah, this is why it's nice to actually have some cash reserves, especially if you're just seeing constant bull markets. You can just park a little cash over to the side, wait for something horrible to happen and go, well, wonderful, it's time to go shopping. And then you go buy all these discounted securities. Yeah. Yeah. And then when things recover.
Because last time I did that was 2020, and we bought some energy funds and high dividend funds for clients, but it was only the clients that said, yes, let's do it. A lot of them are scared because you're standing with the abyss. There's no guarantee it's gonna get better. That's why the prices of it. That abyss can keep going from 2008 for another 10 years. That's why we say the first 10 years, allocate, do all the emergency money. Beyond that, don't worry about it, but within 10 years, you don't know. It can get bad. If this government sent a higher debt than it's ever, we could have it in 2008.
Relative to the last screen, and relative to, crash of like First Republic Bank and some. What was the difference between that happened then, but a couple of years ago to this, and why didn't the government fund those guys?
That's a good question. I don't know if I can answer why they didn't bail them out, unless you have any insights on that, but
I don't know. It said my stocks now about $5.
Yeah.
yeah, because there was essentially a run on banks, was essentially what was happening with some of these.
See,
Yeah.
So,
here.
Yeah, Silicon Valley was really bad.
Banks too, and it depend on government, they own investors out, the stock will fall, but there were a lot of banks that were in trouble.
Yeah, like you just mentioned up here, Silicon Valley Bank was one of those as well. Yeah, and basically what happened with those was it was really interesting. There was like there was something related to crypto at one point where a lot of there was like I think Silicon Valley Bank was like kind of related to that, but
They bought treasuries, right? And when interest rates went up, the treasuries dropped in value, making their balance sheet look small. And they had
Right.
shorter term treasuries. So they had cash reserves that they had to keep for the bank, right? Whether it's in crypto or not. And if you invest, and you get greedy because rates are so low, so let's buy a little bit longer term treasuries, like a 6-year treasury, you get a decent interest rate, but you're supposed to have it in short term position. So you can give people back their money. But when there was a run on the bank and your treasuries had to be sold at a loss, treasury.
Yeah.
They didn't have enough money to get back to the investors, so the government had to take over, bail the, but not the investors, the CEO. And then the common stock like that.
Yeah.
So it's like if you put all your savings on a 30-year bond and rates go up and now you can only sell it for 70 cents on the dollar, but you are required to have a liquid reserve. You no longer have enough as a liquid reserve. The banks got greedy trying to make a little money on longer term treasuries. Treasuries will never drop in value, but interest rates, the Fed had to raise them really high to slow inflation. Those treasuries that they would have had to sell dropped them below the minimum reserve.
But why did the government kind of do this?
These were the biggest banks. They gave them the short-term loans, and this time around, they didn't want to be seen as trying to bail out banks.
yeah, this would have literally collapsed the economy.
Yeah.
That didn't really do anything. Like,
But the politics behind it was they don't want to bail out stockholders, they'll bail out CEOs. Kind of like with GM, they bailed out the bondholders, well, the union, but they didn't bail out the stockholders.
Yeah.
Back to the. Problem. That was under the fourth one. Yeah, well, that was Frank.
Yeah.
They're required.
Yeah, oh, yeah, yeah, well, their biggest fear was they were redlining areas to terminate certain people, so the government stepped in and said, no, you have to provide these loans. But it was a very famous lawsuit, it was the redline in Chicago, and where on that case. That's, yeah, it's just difficult to have the government control these things. You gotta let it free market. Yes.
Yeah. So the only thing that we can do is we can't predict these market recessions. We can't see what's going to happen beforehand. 2008 was a little unique because you could see a lot of indicators. You could see default rates going up, but the bond credit ratings not changing. So that's likely where some of these people at these conferences got this idea that something was going to go wrong, is because the bonds continuously got worse and worse and worse. But S&P and Moody's went la 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 la. That's still a AAA, and then it wasn't, and then gone. Valuations of those bonds just destroyed. So that was kind of a unique situation. We can't see everything coming. We couldn't predict COVID, and that happened. But what you can do is make sure that you just manage your exposure to risks like this. Understand, look at these black swan events, look at your portfolio and the relative risk that you have, and see what would happen. If 2008 happened again, would my portfolio even survive the next few years? Would I be all right to pay out my distributions, do whatever it is I need to do? That's why we like lateral integration so much, because you're paying attention to what you actually need to do. And if your growth securities are for later term objectives, a recession is going to be fine. If anything, you can rotate in a little bit more aggressively and ride the wave up and just get some of that cash in there to participate in the discounted prices. But you don't want to be over allocated, because if you were totally allocated in things that all fell really strongly during any of these crises, you could have been destroyed and your portfolio would not be able to serve the function that we created it for. So just make sure that you pay attention to your allocations, make sure you pay attention to what you're trying to accomplish with your portfolio, and understand that volatility is real, that black swan events are very real, and that you will have to feel them at some point through your financial life, most likely. And just be prepared for that. And don't let it push you off the track. Stay going towards that end objective, and as things recover, you will do just fine. And that takes us 15 minutes past our class end time, but I hope you guys enjoyed the extended discussion, and I hope you all learned something.